despite the GDP numbers being better than expected, actually, if you look at the inflationary trends in Australia, they're actually quite contained. So I think just on the Australian data, where COVID has been quite well managed, okay, we've still got some of these lockdowns, but that would indicate that we're not seeing significant inflationary pressures building. I think in other markets, and particularly in the commodity space, and you referred to the US, clearly there have been bottlenecks in the supply chain, and that's why you've seen copper price, iron ore price, oil all spike, and that's clearly having a significant impact into the short-term inflation data as economies reopen, and clearly that's going to subside as more supply comes online. The bottlenecks ease for certain commodities. So I'd say, iron ore being a good example, whereas other commodities like copper may have more structural long-term trends with electric vehicles, batteries, etc. So it's not for all commodities that there's going to be no further inflationary pressure, but I don't think that for the entire basket of commodities we're going to see this sustained over the longer term.
Okay, so because of your belief in the transitory nature of inflation, it doesn't look like you've done any major portfolio shifts at this stage. Are you hedging a little bit, though, for the risk that perhaps it's not transitory?
Yeah, very much so. And look, if we're just talking now 5 months into the year, and hindsight is very easy. I mean, I wish we'd done a little bit more for my strategy. I mean, we did rotate into some of the developed market banks within the region, which benefit from the higher interest rates, higher move up in treasury yields. We didn't move into that commodity space, and certainly that's hurt in the short term. So we continue to hedge in some way, but also we have seen a big sell-off in some of the structural growth areas like technology. Some of that has been due to the regulatory pressures, particularly in China. And I think that the valuations in some of the technology areas in Asia actually look very reasonable based on cash flow and profits. And where we've seen a big correction in tech stocks, particularly in the US, has been in the less profitable areas of technology. So we're still overweight, if you like, the structural growth areas, which include technology and consumer. And we're not chasing some of the areas that we've missed out on. I mean, again, in hindsight, Australian banks have done very well this year, and the materials stocks in Australia. But I think that in some of those cases, I think that's less likely that it's going to sustain on a 3 to 5 year view relative to the structural growth stories in technology and consumer that we can get in Asia, ex-Australia.